Well, happy Friday from Eagle Financial again after a wild week. Market closing up today 1.42% on the jobs number this morning. We've got LSU at home at 11 a.m. tomorrow playing Utah State. And then Sunday for all you Saints fans, we've got Tampa Bay visiting at noon. This week we had quite a market. You could call it a roller coaster. I had a friend of mine from Virginia, call this thing a bucking bronco. The market for the fourth or fifth time this year, and it does this in September and October quite a bit, has tried to shake some of us out of the market. But as we've said before, it's a time to stay put, stay the course. On Monday, we closed out the third quarter, September the 30th. We had some typical window dressing that goes on, some market maneuvering to close out the quarter, make the statements look good. We don't do any of that, right, Bill? Never. So the market closed up about 0.5% on Monday to close out the third quarter with the S&P 500 up over 20%. And then all hell broke loose, pardon me, on Tuesday. The ISM Manufacturing PMI Index number came out at 47.8. Typically anything under 50 is recessionary. This number had peaked in August of 2018 at 60.8 and has come all the way down to 47.8. That number was the worst number that we've seen in over 10 years, Bill. This number 47.8 has been a recessionary type number 61% of our economic history. I borrowed that from our friend at Breakfast with Dave at Gluskin Chef, Dave Rosenberg. So the S&P declined Tuesday 1.1%. We come in Wednesday and we're down about 2% on China trade and some other things. Impeachment talk. I don't think this impeachment talk is really bothering the markets a whole lot. And then we come in on Thursday. So the market has started off the first 2 days of October down over 3%. Thursday we get the ISM services number, which has been stronger this year than manufacturing. The consensus for this number was about 55, and we came in at 52. And again, 50 is a recessionary number. So the market sold off another percent. Now we're down over 4% to start off the week on the stock market, making a lot of people, quite nervous. The roller coaster, bucking bronco. Okay, then all of a sudden, market falls, over 300 points on the Dow in under 2 minutes Thursday morning with this ISM services number. And then we get a sharp reversal. The next thing I know, I'll look at my screen and we're up. And this is on the belief very quickly that we're getting back into this Goldilocks thing where the Federal Reserve is going to come to the rescue. And we had the futures markets indicating yesterday about a 53% probability that we're going to have two more Fed funds rate cuts this year before 2020 gets here. So today we had the very important monthly jobs number that comes out the first Friday of every new month for the prior month, and it looked like a miss. The number was the market was looking for 140,000 new jobs to be added for the month of September. It came in slightly below that at 136,000 jobs, but we had over 50,000 in upward revisions. So, and I heard Jerome Powell talking about this today. He thinks the economy's, right on track, doing just fine. So for the week, the market was down over 4% at one point, and it rallied sharply to both Thursday and today to close out the week, Bill, down about a 0.5%. But the bond market continued to rally through the whole week, so we're still in this seemingly secular downturn in long-term Treasury yields. The 2-year note closed to yield about 1.45 today, below the 10-year note yield, slightly over 1.5 or 1.52%. So note that the 2-year is below the 10-year slightly. That means that it's not inverted. That's a recessionary signal if it's inverted. So we had a steepening this week, which is a good thing. And the 30-year closed right at 2%, back into the realm of rarefied air that we've talked about. 30-year Treasury note yield only at 2%. Tying up your money for 2%, we would avoid that trade. While our 10 and 30-year bond yields are much higher than the rest of the world, there's just too much risk involved in trying to buy, a 30-year bond trading at 50 times what you get in earnings. Gold closed down slightly today at 15.10. West Texas Intermediate was up slightly today at 52.88 for a barrel of oil, but down sharply for the week, along with nat gas coming in at around 2.30. So that's kind of a market recap. Things kind of normalizing here a little bit, and I thought
before you do that, Jack, I think we could summarize this volatility that we've been seeing in the equity markets as follows. We have this kind of tug of war going on. The market is digesting economic data points. We've had the yield curve inversions earlier in the year, combined with slowing global economic data, and this most recent data, these ISM numbers, do make market participants a little nervous that we are approaching recession. You can look at that different ways, and of course you get a room full of economists. You'll never have any agreement between a room full of economists. So you have that, but then you also have the acronym TINA, there is no alternative. And so in this environment of very low interest yields, there's no compelling case, as Jack said, to type your money for 10 years earning 2% in a treasury, for example. So it does continue to support equities as a place to earn higher yields and higher total returns than you can in bonds. So this is what's going on right now, this tug of war. Until we can get better clarity as far as recessionary signals, as that goes, and also what's going on with the election. Until we get better clarity, we will probably continue to have more volatility in the markets.
Yeah, and I'd like to throw in there, it looks like on the Democratic ticket that Elizabeth Warren is going to be the candidate to beat now, with Joe Biden kind of slipping, and I think things looking worse for him, especially with what's gone on in Ukraine. But we might add the markets were up today more on China trade, I think, than the jobs numbers. So we just had this reassuring thing that the economy is not too strong, not too slow, kind of Goldilocks. Trump's tax cuts that we got in there a while back are still having an effect. But I think what's important about, the newsletter that Bill wrote most of it here that we put out, that's on our website, talking about political aspects of the market. And we talked about how it relates to geopolitics, to commodity prices and things like that. But I think that the danger here for Donald Trump is if we go into recession, it's going to be very hard for him to be reelected. So he's going to be doing everything humanly possible to keep the economy growing, steadily, at least until November of next year. That brings up another thing about seasonality in the markets. Historically speaking, most of your gains in the stock market come from November to May, and then so that's, you want to buy in November and go away in May. That's if you bank on that, it's not going to work. But we've had, just looking over what happened with the third quarter this year, most of our gains came in the first quarter with the stock market, and then it's been muted for Q2 and muted a little bit more for Q3 with more and more volatility in there. And so, this is, we've had a lot of volatility at times this year, though several moves down of the S&P, more than 4 or 5%, Bill, which, we've gotten some phone calls from some people that get nervous and what am I supposed to do and so forth. If anybody has any questions like that, we'd just like to offer our services and say, give us a phone call, because if, as we say, the stock market has likely made most of its gains this year and bond yields are only 2%, what should you be doing with your money? And we've got some creative ideas. We've got some great income ideas, we think. We're doing some things in the alternative space that's very different from most of the competition that's working, we might add also. But so, we'd like to, what would you like to add to that about the services that we offer and how we're different here at Eagle Financial, William?
I think probably the biggest differentiator between Eagle Financial and many of the other firms in the marketplace is that we are a registered investment advisory firm, or RIA. We're not a broker-dealer. We're not commission salespeople. We don't sell anything. We don't get compensated by commissions. Instead, we are fiduciary advisors. And there is a lot of confusion in the marketplace, especially amongst retail investors, because there are so many titles thrown out there by people in the industry. Financial advisor, investment advisor, financial counselor, financial planner, and the list goes on and on. But really, if you look at it from the standpoint of a regulator, you're either an investment advisory firm or you are a broker-dealer. And you are, as an employee, you are a registered representative of an investment advisory firm, or you are a registered representative of a broker-dealer. It's that simple. It's that black and white. And as a registered investment advisor, Eagle Financial has a duty to act in the best interest of its clients. We have to fully disclose conflicts of interest. We have to do what we believe is best for the client, putting their interests ahead of our own. We sell no proprietary products. We don't sell anything, as I mentioned. So the bottom line is that we are working on behalf of the client first. I think that's the most important thing that we could say about our work here at Eagle Financial. It doesn't mean that we're going to be great. We certainly do our best. But our clients do have that confidence in knowing that we are putting their interests first.
That's right. So we're, just to reiterate that, we are a fee-based firm. So if, we're going to be doing client reviews for the third quarter. That's what we're getting ready to do. It's a very busy time for us with the start of every quarter. We keep score net of fees, and we basically only get paid 4 times a year because we bill our clients quarterly. And if the account goes up in value, we get compensated a little bit more. And if the account value declines, our compensation declines. So we're on the same side of the table. And as Bill iterated, it is against the law for us not to act in the best interest of our clients. There are many things that a Merrill Lynch broker could do today, for example, that's perfectly legal, but for us, we could get fined $10,000 and get thrown in jail. So,
Well, and let's just say that about, you know, the difference between the broker dealer and the registered investment advisor in terms of offering investment recommendations. We are fiduciaries. We are subject to that standard. Broker dealers and their representatives are subject to a suitability standard. And here's where it can get a little muddy, and here's where conflicts of interest can come into play. If you are a broker dealer representative and you are sitting across the table from a client or prospective client, and you've spent the time interacting with that client, coming to understand their goals and objectives, and you have an array of products that you can sell them that would be deemed suitable. But these products can be anything from mutual funds to individual stocks and bonds to annuities to other things out there, and they all compensate the salesperson differently. So there's an embedded conflict of interest because that individual knows that he or she will be compensated higher or lower depending upon what they are recommending. Now, I'm not saying that to condemn the broker-dealer industry. Jack and I both worked in the broker-dealer industry before we came over to the registered investment advisory side of the business.
and got enlightened.
But that is an everyday conflict that broker-dealer representatives face. Now, on our side of the business, we don't have those conflicts. So whether we recommend product A or product B or product C matters not to us. We are product agnostic. We are going to recommend what we believe is best for the client.
That's right, and that means lowest cost, best performing, best risk-adjusted returns, that sort of thing. We're not biased to, any kind of a product. So, and I like that too, because we've talked about bond yields and so forth. One of the biggest problems that we see today is it's very difficult for a broker to make money selling bonds with interest rates this low, just the way the mathematics works there. So where, a lot of the broker dealers run their bond inventories like a used car lot, you buy what clients have sold into their inventory, and then they mark the bonds accordingly. You can't make much money as a broker selling a bond unless you go long dated. So as we've said, that's or junky. So if you go low credit quality and high yield, or very long term, you can bury a large commission in there without changing the yield a whole lot. So that's an incentive to do the wrong thing for the client, and we don't want to point fingers or just say this is how we're different. We like buying short term bonds if we like the bonds all day long, because we're just not compensated in that manner.
And Jack, by the way, that broker-dealer bond markup that you were just describing does not have to be disclosed to the client.
That's correct.
So the account holder has no idea, how much that markup is.
And again, that's very different from the way that we do business. So, yeah, we just wanted to talk a little bit about how we do business. If anyone has any questions, please write in or give us a message on Facebook, and we appreciate all of our clients, all who are watching, and that's pretty much a wrap, I think, for this Friday. And go Tigers, go Saints.
And if you're in the Shreveport-Bossier area, come to the Red River Revel. Participate in our local arts festival.
Or the film festival
The
this weekend.
film festival as well. Yes, thank you. Have a great weekend.